Hello, value investors. Thank you for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about DoorDash. I'm going to highlight the good and the bad aspects of DoorDash and why paying up 13 times next year's sales isn't as criminally as expensive as it may seem on the surface. So here's the big question that I want to just put out is that we can see that over time, DoorDash's revenue growth rates have materially decelerated. We can see that coming out of Q4 2020 is growing at 226% year over year. Then as we fast forward 6 months, we can see this rapidly tailoring off so that its top line is growing at 83% year over year as of the last quarter. So immediately we can see a very rapid deceleration. We're talking like, more than 100% deceleration on its top line from 226 to 83%. So with that in mind, you have to minimally be willing to think about how does next year look. So is it likely that DoorDash can grow next year at, let's say, 50% or 20%? That will have a huge implication on how investors view this stock and how investors price the multiple to this business. So that's the kind of headline that everyone is thinking about. But as we go beyond that, I wanted to highlight some other aspects, okay? So DoorDash has the illusion of being very capital intensive. However, when everything is said and done, it's actually not that unprofitable. And we can see here that for Q2 21, it was negative 100 million, okay? So for a company that's making more than $1 billion on the top line and trying to go for a land grab, it's not actually burning through that much on a GAAP net income basis. The other thing that I wanted to highlight is that we can see there's a progression from Q4 2020 to Q2 21, where it's been growing from negative 300 million to negative 100 million. So there is a progression, quite a steady progression, as it moves towards break even. Another thing that I wanted to highlight, just to give you some round numbers, so we can see many companies in the tech space that are only profitable once we add back the stock-based compensation. Now think about the following, okay? So for the first half of 2021, DoorDash's stock-based compensation was 235, okay? So if we make some assumptions here, okay, so we assume that it doubles over, for the 2021, and then we look at and we say, okay, so let's make an assumption that it grows the stock-based compensation slightly more over 2022. Let's say it reaches 490 million worth of stock-based compensation. At the same time, let's make some assumptions. So we know that for this year, they're guiding for the top line, for the EBITDA to grow at the top end at 350 million. So let's say that it grew, remember, keep in mind that it grew by more than 80% from 2020 to 2021. So let's assume that it decelerates the EBITDA growth so that over 2022, it grows to 570 million, okay? So with that in mind, if we subtract the 490 million of stock-based comp, we can see that it's already going to be making approximately 50 million of GAAP net income. Now, remember, this is actually clean income with everything being added in, okay? So many software companies are being priced at on a profitable basis, but actually don't make clean income, GAAP income profit. So this is something that's quite worthwhile considering, and many investors are not really willing to think this through and project out. Another thing that I wanted to remark is that in Q4 2020, DoorDash's GAAP net income was negative 32%, okay? So negative 32%. And as it grows its top line over the next 6 months by 27%, it's actually GAAP net income goes from negative 32 to just negative 8. So this is a remarkable amount of operating leverage in the business model. So it's not inconceivable that if DoorDash's top line over the next 18 months grows cumulatively by 30%, it's not inconceivable that we may see by the end of 2022 positive 5% on its GAAP net income line. So with that in mind, it goes from a business that's just burning a significant amount of profits to grow its top line to something that is already making profitable 5% on the net income line. At that point, it really breaks the bear thesis, because the bear thesis is that this is never going to be very profitable, and it actually seems that it's actually closer than one would be led to believe on the surface. Now, let's put the other side of the question. Right now, investors are paying approximately 75 billion market cap for DoorDash. Now, if we fast forward and we think about next year's top line, this puts a stock price at approximately 13 times next year's sales. For a company that may or may not be growing at 20% next year, this is a punchy multiple. On the other side of the equation, if you have to think about, I would like to see clear evidence that DoorDash can sustainably grow at more than 35% year over year. If it did, that would be a reasonable multiple to pay for something that is showing a clean path towards profitability. Paying 13 times next year's sales, if DoorDash can sustainably grow at 40%, okay, this would be a no-brainer investment. You just kind of, that would be very compelling. But there's this question, can it stabilize its growth rates into 22 and beyond? So with that in mind, I've kind of tried to put out some of the positive aspects, some of the negative aspects, and just to give you a few things to think about as we dissect DoorDash's investment. As I already alluded to, paying 13 times next year's sales isn't that compelling for me for what I believe will be middle of the road revenue growth rates. Now, if you want to find out what kind of stocks I'm interested in and I'm particularly bullish and I'm deploying my capital towards right now, check out my marketplace called Deep Value Returns. You're welcome to do a totally free trial to see if it suits you. You can cancel anytime before the 14 days and you're not going to get charged anything at all. We have a growing investment community of value investors, and if you're willing to do, if you're wanting someone to do some due diligence, or you haven't got the time or inclination to really figure out potential avenues to invest your capital, or you're kind of new to investing and you want someone to help you with some hand holding, don't forget to check out my marketplace called Deep Value Returns. And you can check out the reviews and see what other people have said on my marketplace. You can go through, you can see the 5-star reviews, and you can see if this is something that suits you. In any case, I hope to see you next time. Bye bye.